This simply puts probabilities in your favor in one specific direction for the strategy that we're going to discuss here today. Third of all, ETFs and indices typically have deeper liquidity, and these are the strategies that offer daily expirations. Now, even though we're not using the daily expirations, we'll talk about how they're applicable even when you're selling weekly options. So these options will have tighter bid-ask spreads, which means that you will pay lower transaction costs selling ETF or index options than you will on single stock. And the daily expirations allow strategies to start any day of the week. So even though you're trading weekly options, you don't have to trade Friday to Friday. So when you're trading single stock, you have to trade Friday to Friday. But when you're trading ETFs, you could trade Monday to Monday or Wednesday to Wednesday, depending on your schedule. And having that daily expiration just gives you that flexibility to choose which day of the week you want to establish your weekly option selling strategy. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. So important thing to remember when you're selling weekly options, you have to stick to the ETFs and the indices for selling them, selling weekly options. Do not do this in single stock names. So now that we've kind of identified that, it's also important to understand what is the difference between an ETF and an index option. There is differences, and we'll actually talk about that later this month as well. We'll do a whole session just on that alone, but just at a very high level. Typically, ETFs will be better, in my opinion, for this because they're better suited for retail traders from a contract size perspective, and they generally offer the same type bid-ask spreads. So if you think about it, SPX, the Nasdaq, S&P 500, that's over a $500,000 notional value dollar contract. So just minimum contract size, you're trading much larger size versus SPY. It's a $50,000 contract. So you're talking about 10 times smaller. You look at Nasdaq 100, that's a $1.8 million contract versus Q's is about $40,000 contract. So, or $45,000 contract. So you're talking about, about 5% of the notional value. So from that perspective, I think ETF give you very similar risk profile to selling index options at a size that's far more favorable for most portfolios. When we talk about the strategy here today, we'll talk about short puts and cover calls. Only in ETFs will the short put assignment allow you to own the stock that can then allow you to sell cover calls on the stock to continue generating income. Index options are cash settled, so you will never actually own the underlying index, which doesn't allow you to sell a cover call. So that's one other downside to index options in that particular case. ETF options are all PM settled, so it's easy to work with. Some index options are AM settled, which makes it more confusing. There's overnight risk, and I generally don't recommend that for most retail traders.